All right, let's talk about two financial paths. They both start in the exact same spot with the same amount of money. But, and this is the key part, they end up in completely different places. This is the real story behind investing versus trading. So, picture this. Two people. Both start with, say, $1,000. One of them, well, they quietly build a small fortune over time. The other, they end up with pretty much nothing. And you know what? The difference between them wasn't luck. Not
You're
at
in
all.
the same market, starting with the exact same cash. So what is it? What's the one single thing that leads to such huge opposite results? Well, that's exactly what we're going to unpack right now.
Okay, so first things first. Let's really get into the nitty-gritty and understand the core ideas behind these two very, very different
By
approaches.
the time we're done here, you're going to know the real difference. We'll look at which one is safer, which one actually has a track record of making more money, and, this is the big one, what a beginner in the US should really be thinking about doing.
You know, to really get a handle on this, let's use a super simple but really powerful analogy. I call it the tree versus the phone.
Okay, so investing, think of it like planting a tree, right? You pick a good spot, you plant this little sapling, you water it, and then you wait. You've got to be patient. And over the years, that little thing grows into something huge, something really valuable. It's all about nurturing that growth over time.
Now, trading, totally different ballgame. It's more like flipping a phone. You're out there hunting for a deal, you snag it for a low price, and then you try to sell it fast for a quick profit. The goal isn't to watch it grow for years. It's all about that quick in-and-out transaction.
And right there, that's the core difference in how you have to think. Investing is a marathon. It's slow and steady. That's how you build real wealth. Trading, on the other hand, is a sprint. It's fast, it's intense, and as we're about to find out, it's just incredibly risky.
Look, analogies are great for understanding the idea, but let's get real. What do the actual numbers, the hard data, say about how this all plays out? Okay, so historically, if you're a long-term investor and you just put your money in broad U.S. market funds, like the S&P 500, you've seen average annual returns of around 8 to 10%. Yeah, it doesn't sound flashy, I get it, but that consistency is incredibly powerful over time.
But now, let's flip the coin and look at the data for traders. And honestly, it's pretty shocking. Study after study confirms exactly what you're seeing here. The overwhelming majority, we're talking 80 to 90% of day traders end up losing money. Just let that sink in for a second. For most people who even try it, it's a losing game.
Let's bring this back to our $1,000 to make it super clear. Imagine you're the investor. You put that grand into some solid, diversified companies, and you just leave it alone. Over the years, that money starts to compound. It turns into $2,000, then $3,000, and it just keeps growing. Now the trader, they're buying and selling maybe every single day. Sure, they might score a few wins here and there, but the losses, they really start to add up. And way too often, they end up with less than the $1,000 they started with.
So you have to ask, right? If the numbers are this clear, why on earth do so many people get sucked into the riskier path? Let's talk about the biggest traps that catch beginners.
And this really hits the nail on the head. Let's be honest, investing can feel kind of boring. It's slow, but that's the thing. It's what actually builds wealth. Trading, on the other hand, feels exciting. It's fast, it dangles the promise of quick money, and that very thrill is what ends up destroying most beginners. It's so important to remember this. Fast money is tempting, but slow money is powerful.
Okay, so let's get specific. What are the actual reasons, the real pitfalls, that cause so many would-be traders to fail?
It really boils down to this toxic cocktail of four things. First, you've got this desire for instant success. Then you hop on social media and see these so-called gurus showing off their big wins, and that creates this intense fear of missing out, FOMO. But the real trap, it's your own brain working against you. Emotions like fear make you hold on to a losing stock way too long, and greed makes you jump in and buy right when the price is at its peak. And all of this is happening because people dive in headfirst with zero real education. It's just a complete recipe for disaster.
All right, so we've seen all the traps. Enough about the problems. Let's talk about the solution. Let's build the foundation you need to avoid all of that. Here's a clear 5-step plan for any beginner out there. So for any beginner in the US, this is your playbook. Step 1, focus on investing, not trading. Step 2, keep it simple. We're talking low-cost index funds, like one that tracks the S&P 500. The great thing about that is you're not trying to pick a winning stock.
You're instantly spread across hundreds of the biggest American companies. Step 3. Be consistent. Invest a certain amount every month. It builds discipline and helps you average out your costs over time. 4. You have to think long-term. At least 5 to 10 years, maybe more. You need to give your money time to really grow. And finally, step 5. If trading still seems cool to you, learn first. Get educated. Build that solid financial house before you even think about adding on a risky extension.
When you really get down to it, this is all about making a choice. A very conscious choice about the kind of financial future you actually want to build for yourself.
So let's just recap the big why behind all this. Why do they work so differently? Well, investing works because, over the long haul, good businesses grow. They become more valuable. Simple as that. Trading is so risky because, in the short term, the price of a stock isn't really about the company's value. It's driven by pure emotion. All that day-to-day noise is just fear and greed talking.
So you see, when you choose a path, you're also choosing your destination. The path of patient, steady investing, that leads to wealth, peace of mind, and eventually freedom. But the path of just jumping into trading blind, that almost always leads to stress, big losses, and a whole lot of regret. It's the same market, but you end up in two totally different worlds.
And I want to leave you with this one final thought, because I think it just perfectly sums up everything we've talked about. Trading can make you feel rich for a moment, but investing can make you rich for life.
So, there you have it. The two paths are clear, the ideas behind them are simple, and the results are worlds apart. The only question left now is, which future are you going to build?